Good afternoon, everyone, and welcome to the third session in our three-part series on zero rates and what they mean for managed accounts. On Monday, we dealt with issues of advice and implementation. And on Tuesday, we took a deep dive with two fixed interest specialists looking at the situation for fixed interest now and their predictions for the medium term. Today promises to be a particularly interesting session where we're looking at the traditional defensive portfolio goals, be it downside diversification and income, and alternative strategies to achieve those ends. We have three experts in the field with us today. We have Peter Tiffin from Ironbark, Andrew Lowe from Challenger, and Nigel Crampton from Milliman. Michael Karagianis will be steering the ship, as he has for the other two sessions, and he will introduce the speakers in more detail. Later on today, I believe, we'll be sending out the link to recordings of all three of the sessions as well as the presentations. Presentations have quite a lot of data in them, and it's worth having a look if you have any questions at some of those slides, which might be able to answer them. The other things that I wanted to mention were that you can ask questions, as you can see on the screen there, the Q&A button at the bottom of your screen. And we will do our best to get to those questions during this session. And if not afterwards, we may be able to get some of those as well. Finally, I just wanted to mention that IMAP will be having a portfolio management conference in Sydney and Brisbane and possibly Perth in February next year. We'll be sending out more details of that, but please take note and maybe clear February. Without further ado then, I'm going to hand over to Michael.
Amanda, thank you very much, and welcome everyone for the third in the series. As Amanda mentioned, we've had I guess a journey this week where we started off with discussing some of the issues associated with the zero interest rate environment and how to build defensive portfolios from a very top-down perspective. Wednesday was really about more of a deep dive into the fixed income space, and I think that was very interesting. Some of the conclusions, I think, to date that really try and set the scene for today's session, that really with the collapse in interest rates, it's not likely to be a temporary phenomenon. It does have a whiff of structural about it. And certainly for the foreseeable future, people do have to think much more carefully about how they build the defensive sleeve. And in particular, three elements that we focused on: the pursuit of income being very important, traditionally provided by fixed income, not necessarily the case anymore, certainly with more conservative fixed income type strategies. Defensiveness, the ability to induce a diversification in the defensive sleeve of a portfolio so that it can offset the volatility that we may see in other parts of the portfolio, particularly equity risk beta. And that perhaps has been a little disappointing, particularly where we've seen credit markets this year, and indeed going back as far as the GFC, behaving with a very high level of correlation with equity markets. So there's a question mark over that as well. And of course, liquidity. How do we build that defensive portfolio so that we can draw on liquidity as and when required, either for the normal purposes that clients have in drawdown phase, perhaps in pensions, but also perhaps when markets get dislocated, how do we fund increasing investment into growth assets? So it is a challenge. As I said, Wednesday was really about looking at the fixed income side and what to think about that. This is really looking further afield, and we've got three practitioners coming from very different perspectives, which I think makes it very exciting. I think the challenge will be to really get people on the same page in terms of how to address those issues. But they are coming from very different perspectives in terms of how to fulfill at least some parts of that tripod of requirements. Joining me, we have from Milliman, Nigel Crampton. He's head of managed accounts, responsible for strategy and development of the Milliman managed accounts, which we'll talk a little bit more about. Prior to joining Milliman, he was senior leader within the Fitzpatrick Private Wealth Group. Also joining me is Andrew Lowe, Head of Technical Services for Challenger. More than 20 years technical experience, including roles with AMP, ING and ANZ. And lastly, but certainly not least, Peter Tiffin from Ironbark Asset Management. Previously with Price Waterhouse, he's admitted to the Institute of Chartered Accountants and has had over 20 years experience in the asset management industry, working with large players such as HSBC and Credit Suisse. So some very experienced people coming from very different perspectives. What I'm going to do in terms of the order of business, as we've done through the course of this week, really invite each of them in turn to give us, perhaps 2 or 3 minutes introducing themselves, introducing their perspective on the issues at hand and how they propose to address it, and then coming back and having a deeper dive in each of those component parts, and then opening up to Q&A. As Amanda mentioned, please, as we go, put your questions down and we will look to endeavour to answer them through the course of this presentation. So with that in mind, I will throw firstly to Nigel to really give us a perspective from his point of view and from Milliman.
Thanks, Michael, and good afternoon, everybody. We've certainly heard the phrase, we live in interesting times, bandied around frequently over the last couple of months, and that's absolutely the case as a result of COVID. But one of the things that certainly struck me in listening to the previous sessions run by Michael this week is it's become obvious that the economic environment we are working within in that framework has certainly changed. And as Michael alluded to earlier in the week, we need to look outside the box going forwards. I certainly agree with that. However, I would urge us as an industry to be cautious as we do look outside the box, that we don't assume that increased levels of complexity or costs result in a stronger solution. So I sort of suggest that up front. And on the back of Milliman's consulting pedigree and expertise in risk management, we have seen in industry over times build products that very much don't fit within advice processes. Which led Milliman over the last 12 months to consult with advisors in how we could bring our institutional grade capabilities and provide an explicit risk management solution to advisors for their investors. And it was really built on 3 core tenets, which we think are critical in achieving what you're expecting or what your clients are expecting with respect to their goals. You can see there that we are focused on having it being simple and affordable, and affordability for us means less than 50 basis points. It includes the Milliman institutional grade portfolio protection, and I'm sure there'll be some questions later that we can take a deeper dive in with respect to that. But the great thing about using it within a managed account structure is it's highly accessible. Importantly, liquidity, so it's got daily liquidity, it's fully transparent, and provides an additional string to the advisor's bow in terms of in their toolkit by having the flexibility to turn the protection on or off. So, low costs, affordability and accessibility are critical, we think, for advisors, given the complex regulatory framework that you already exists within. So in many ways, our view that it's important for clients that are wanting certainty to include an explicit risk management strategy within their portfolio. But at the same time, a good risk management strategy shouldn't be seen or heard in good, steady rising markets. So we look forward to sharing some insights on how we think we can assist the industry going forwards with respect to that.
Right, thank you very much, Nigel. I will now throw to Peter from Ironbark to give us his perspective.
Thank you, Michael and Nigel. I'm the head of investments at Ironbark, and my role here is really to facilitate discussions internally about what direction we think markets are taking, and then trying to find managers who we think will effectively capture that alpha. So we cover both traditional and non-traditional asset classes. And even within the traditional asset classes, recently we've been trying to look at ways we can find some inefficiencies, and we've added global micro cap, and we're looking at climate change in that area. But the area of today's focus is on alternatives, and in the alternatives area, adding to our portfolio. Some of the things we're looking at is mid-market unlisted infrastructure. And we're really intrigued at the moment about Chinese government bonds and Chinese convertibles as a solution, trying to find a solution there to the fixed income and generating some yield in that sort of area. So today, what I thought I would do is sort of talk a little bit about our process, and because I've identified that really my role is not dissimilar from advisors in trying to find managers that are doing a good role, and sort of give you some tools and some examples and experiences we've had that may well help you identifying alternative managers you'd want to pick. And one of the reasons we've got that is, if we go to slide 10, is there is a conventional wisdom there that when you're looking at portfolios, what we're trying to do is get that orange line. And the reason for that is we're trying to help investors avoid panic. And if the dark line there is the equities, getting out early and experiencing a much lower overall return. I think it's an interesting debate, and we may come up with that today. But really, the experience that we've seen with investors over this period is, did people actually get out of equities, and was that because of time and what was going on, or is it that our investors have listened to people saying, you've got to maintain exposure to equities, and perhaps we don't see people dropping out as often as we have. And I think there are some reasons for that as well. But as I say, they're the things I'd like to do. I'd like to be able to say that I think alternatives will form part of a good portfolio. I'd like to explain why I think managers need to be transparent and give you some tools that you can compare them to. And overall, my view is that there are plenty of alternative managers we're looking at. And if our managers or any other managers can't explain to you their process in the way you want to understand it with really good attribution, then walk away. It's a better thing to do. There is someone else that you can understand.
Okay, Peter, thank you very much for that. Andrew, last but certainly not least, please introduce yourself and Challenger's perspective.
Thank you, Michael, and good afternoon, everyone. Thank you very much for the opportunity to present to you today. And Challenger, very new to IMAP, and very, very pleased to be here. I think we've got a very interesting story in the defensive space for advisors and for your clients, and very pleased to be talking to you today about that opportunity. We are focused on investors and providing them with financial security for their retirement. I'm going to focus today absolutely on the retirement phase of structuring income stream strategies. And we offer a range of different investment solutions in that space, including guaranteed and non-guaranteed options. And I'm going to focus today predominantly on the applications of guaranteed lifetime income streams, and predominantly lifetime annuities, given the Challenger background. So if I focus on the defensive component of portfolios, and I will come back to that a little later, in a low or zero rate environment, I see here on this slide what I think is one of the most significant risks that retirees are exposed to in an environment of low expectations of returns and volatility in growth and other assets. We're absolutely coming across advisors that are seeing retirement plans for different clients at real risk. The risk of running out of income in retirement because assets are depleted is very, very real. And in this slide, I'm referring to it as the retirement danger zone. And I'm going to present today what I think are some ways that we could solve for that particular prospect. It's a very real one. The prospect of living on $37,000 a year, the maximum rate of age pension for a couple, or $24,500 for a single is tough. And we are certainly seeing advisors using the tools, the strategies, the investment products available at their disposal to solve for that. And one of the ways that you can do it is with a guaranteed lifetime income solution. If we were to allocate an amount into a lifetime income stream, effectively we can lock in a layer of income over and above the age pension that effectively solves for essential spending requirements. So come what may, irrespective of what happens in investment markets or how long a client lives, we can effectively solve for that in those circumstances. And I'll come back to solve for that. If I could go to the next slide on slide 13.
Andrew, perhaps in the interest of time, we might come back to this in terms of a deeper dive.
Okay.
But I think that's a really good introduction. And what we'll do is now go back to Nigel and have a deeper dive and understand the approach of all of your perspectives, and hopefully that will generate a bit of conversation and Q&A as well. Nigel, you introduced Milliman's managed account approach, very much a risk-based approach. Perhaps you give a little bit more texture at this point in time. And clearly, everyone's going to come from a perspective today of promoting what the positives are of their particular approach. I think it'd be good to give a little bit of perspective as to what some of the downside issues are that people need to consider, what advisors need to consider when adopting each of the approaches we're talking about today, to give a little bit of colour to that perspective. Nigel.
Excellent, thanks, Mike. So let me share with you a common strategy that retail investors may use with respect to gaining downside, protecting portfolios on the downside, is options. Okay? So a lot of investment banks, you can go and get options there. They are hugely expensive. And I think on slide 5, we've got a chart that actually not only highlights the cost, but what we can see are 2 spikes around the GFC, and on the far right of the chart, COVID. So the cost of options become extremely expensive and very liquid at times when they're most needed. So what we do at Milliman is actually replicate the same payoff that clients would expect from an option in protecting their downturn, but using futures to do that. And it's a common strategy used by investment banks. So if you had an investor go and buy an option from an investment bank, what they would do in the background is go and offset that by using futures and effectively sell the option for you at a much higher price than what it cost them to use the futures to obtain the same result. So we're using futures rather than expensive options to achieve it. The important thing about the explicit risk management strategy that we focus on is we're only protecting against assets that we know have a one-for-one correlation. So an example within our portfolios is we don't currently have any exposure to property. There's no easy way to protect using futures against the property index as an example. Now that doesn't stop advisors constructing portfolios still incorporating property, but what it means is we provide certainty and make sure we can deliver what the portfolio is intended by only protecting where we know we in fact can. There isn't any manager discretion, so it's very much a rules-based approach. And what that requires is a lot of systems, infrastructure that the banks and places like Milliman have. And bear in mind, we're doing this for large institutions, whether that be industry funds or insurance houses around the world. So you need that infrastructure, you need the 24/7 trading and monitoring capability, which is why, whilst they're much cheaper than options, it's not a commonly adopted strategy by retail investors. The other advantage that I just want to touch on, which is really important given we're talking about a low income environment here, is investors remain fully invested in the underlying exposures here. So if you think about the Milliman portfolios, you've got exposure to index ETFs. We don't go trading those, okay? So whilst we are protecting the client's portfolio, we're not trading those and rebalancing those. So that saves on transaction costs. It can have a benefit with regard to capital gains. But what it also means is clients are getting the full exposure of any distributions and income coming out of those ETFs, which is hugely beneficial. And a further part to that is they receive the full benefit of the franking credits. Michael asked the question around, well, what are some of the disadvantages? And it's absolutely right. You can't have a risk management strategy and think that there's a free lunch, okay? So often with these risk management strategies, there can be a drag on the portfolio. But as I've said, it's important that a good quality risk management strategy, is not seen or heard and doesn't interfere in good, steady rising markets. And we think we've got a solution with respect to that. But if I use the example of COVID, of one of the challenges with a risk management strategy, and importantly, if you would explain to your clients and setting the right expectation, you may recall that in the last week of March, there was a significant rebound in markets. So whilst we saved a significant portion of clients' money in the first 3 weeks of March, we had heavy levels of protection on. Clients were expecting us to do that. But what it meant was when the markets rebounded circa 9% in that last 7 days of the month, that the clients in our portfolios would have only picked up a fraction of that. So it's very important that clients understand that they're not going to pick up all the upside, as well as getting protected from the downside. And like you're suggesting to your clients, you need to remain invested for the long term.
Nigel, can I just ask a couple of questions, I guess, to assist in understanding and fleshing this out a little more? So you're using ETFs. I'm assuming they're passive ETFs as opposed to active ETFs. And I guess one question then is it possible to incorporate manager alpha? Because clearly, you know, advisors may have very strong views about the potential for manager alpha. Certainly one of the themes that JANA is pursuing is, you know, as we move towards the end of late stage cycles, manager alpha can potentially add a lot of value. It can potentially detract a lot of value relative to benchmarks. But I'm just wondering that question of manager alpha in the context of your portfolios, how do you take account of that? Whether you do take account of it, is it theoretically possible to incorporate it?
Yeah, great question. So the model portfolios as we have them are using passive ETFs, and that's how we a one-for-one correlation there with respect to the protection, and gives clients the certainty that we know we can deliver. You can use this unit trust. So we actually wrap our risk management within a unit trust, and you can apply that to active management, but you will carry risk. Okay, so you'll carry basis risk with respect to that. What we think and what we've seen advisors adopt over the last 12 months is constructing a portfolio using the Milliman models that gives the clients the core, and then seeking that alpha using satellites and tilts. And having the portfolios at less than 50 basis points frees up that budget so that you can actually invest fairly strongly with those satellite managers where you've got that high conviction and they are deserving of that higher fee to obtain that alpha.
Another question, I guess you talked about, the potential to not fully participate in upside. Obviously, if you're defending on the downside, rules-based approaches tend to have some sort of algorithmic basis to them. They might be momentum-based, they might be valuation-based, they might be a combination of a number of different factors. Without going into too much detail, could you give us a bit of a perspective as to how that operates? One of the problems sometimes with rules-based approaches is as markets fall, it increasingly takes you out of the market. And if you get a quick snapback in the market, you can actually find yourself underinvested for a period of time until the algorithm starts to respond to the new market direction. I just wondered, how does Milliman deal with some of these issues?
Yeah, so you're right. We don't want to get into too much detail in the short period of time we've got, but the benefit of rules-based approach is the certainty and the stress testing that we can obviously provide advisors to share with their clients. We seek to dampen volatility. Okay, so that's certainly one aspect, as well as the protection on the downside, receiving that payoff. What I will say is that the Milliman portfolios have deliberately been tilted in terms of its asset allocation. Because we know we are protecting on the downside, we in fact can take a slightly stronger tilt to growth assets, so that if we are applying that protection when markets start to fall, clients, still pick up the benefit and the rebound more so than they would if they were sitting in a more defensive type portfolio. But we'd certainly be happy to share with any of the audience going forwards some more details around the processes we undertake and what expectations they should be setting with clients.
Okay, thank you very much, Nigel. Well, Peter, an opportunity to dive down a little deeper. You talked about alternatives. Obviously, it's a very wide universe that we're talking about, and there's a lot of idiosyncratic issues. You talked about the need to understand what's beneath the bonnet effectively. You talked about illiquid type assets. I mean, certainly from a JANA perspective, alternatives is something that we do look to apply to institutional clients, and we certainly have looked to apply in the retail space in the context of managed accounts. There are two aspects, I guess. One is, what is the alternative that we're talking about? How can it benefit the portfolio? And the other is, how do you effectively go about investing for it, particularly from a retail managed account perspective? So hopefully in the context of your presentation, you'll be able to dive into some of those issues in a little bit more detail as well.
Yeah, look, thank you, Michael. I'll certainly cover those things. I think one of the things, as I said in my introduction, is the things that I'm really interested in imparting to people is why and how we research these managers and what I think people should be looking at across the board. And one of the first things I talk about is walk away if you don't understand it. And for me, if I could sort of give you an example of what happened many years ago, there's the fund of fund hedge fund market. And many advisors will remember that. And it was large. There was a whole range of different strategies, structures, and fees. And we spent a lot of time. And the JANA folks would have done exactly the same thing. We spent 12 to 18 months really trying to understand what was going on there. And after that time, we sort of found a manager that seemed to be good, and the process was producing really good returns. But the fees were good. But after 6 months of frustration, trying to understand under the bonnet what was really going on with the performance and the process, we reluctantly said we couldn't represent them, and recommended that for their own betterment that they were better off finding someone who could really understand them and explain it to clients better than we could. 12 to 18 months later, we discovered how they were producing these returns when Bernie Madoff ended up going to court. And the reality is we dodged a bullet. Because we thought he was producing a really good return, but the good thing was we weren't smart enough to identify what was going wrong, but we did walk away from that situation. So to help us really understand what's going on with managers, we've got a whole series of tools, but one simple tool which I think could help people in the market, when Michael's saying that there's a vast array and what do you select, and is to divide the alternative managers into 3 categories. And nothing clever, but it's sort of the growth group. And we look at those managers whose biases and structures and processes are likely to give you returns that are directionally similar to equities. And one of those is corporate debt. There's some good corporate debt managers in there, but their returns likely to be similar to equities in direction. There are other types of alternatives which are defensive in our category, and these are ones that will move in a different direction to the equity market. And you're talking there of tail risk hedging, so I'm getting tongue-tied, and also sort of long short managers. And the third group are those managers who are providing uncorrelated returns, and within that group you'll see there's macro managers. But we find that when we're talking to our managers, we insist they provide clear, concise attribution so that we can compare them within those categories to see how they're performing and understand what's going on. And we find that that's a very helpful mechanism. We've got other tools, but I commend to advisors to find their own tools that they want to use, and find managers who can explain their process to the tools and mechanisms that they want to understand it, so they can explain it to their clients.
Right. Just a couple of queries, I guess, in the alternative space. You talked about complexity, obviously. I mean, it's if making the comment, I guess, about walking away if you don't understand it, I think is intuitively appealing. The problem is that there are so many alternative strategies that are intrinsically difficult to understand, and particularly when you start to try and explain it to a retail client. Does that, what you're implying, really mean that the effective universe that we can deal with in alternatives is going to be very small for retail managed account clients? It's, there's just not going to be a lot of strategies that realistically tick that box.
Look, I think my background is more in the institutional space, but I think there's, from what I understand and having looked at the market here while I've been at Ironbark, there's a wide range of different sophistication at the retail level, Michael. And I think there are advisors who are talking to sophisticated investors who can fully understand and appreciate delta hedging and all sorts of things, and there are products that are suitable for them. Likewise, I think there's a whole range of clients who really, they just want to have something that protects them from an equity downturn and reduces the volatility. And again, you've got a range of alternatives there. So from my perspective, what I suppose the message is that for the advisor, you've got to match the product to the client. And so you want, if you've got a client who needs something that you can sell more sophisticated, there are a wide range of opportunities there. But we're hearing from Andrew and things like that, where you've got an area there with people who've got lower incomes. Perhaps something more simple and something you can explain to them is a better alternative.
Playing devil's advocate, one of the criticisms about the application of alternatives, particularly in the period that we've more recently gone through with the amount of volatility that we've seen in equity markets, a lot of equity strategies just did not hold up in that environment. So, some advisors start to say, well, they charge high fees, they're relatively illiquid in many cases, and they, when the market is under stress, they perhaps haven't delivered as we would have expected. How would you respond to that sort of criticism?
Yeah, look, I'd like to respond to the last one first and talk about that framework we use, and perhaps I could talk about multi-asset as an example, where we do have a manager. In terms of multi-asset, I think it's an experience that's not dissimilar to the hedge fund of funds, where, as I said, we walked away. But in the multi-asset, we did pick a manager. Yet it was still an area where there was lots of strategies, lots of underlying structures, and lots of expanse in fees. But we did find a group that had what we thought was a reasonable fee structure. And look, I'm blowing our trumpet, but I'm pleased to say that they performed really well in the sort of the February, March area. And I think if you look at the multi-asset space, there's a divergence of returns. And as I said, when I talked before of the strategies to put into those three categories, I didn't mention multi-asset, because I don't see multi-asset as an asset class. I think it's an implementation strategy. And what you need to do is look at each of those managers. And there are, within multi-asset, there are a group who, they were more growth, more likely to be emphasizing the directional in the equities. The success of those groups is how much less than equities did they perform, right? Because they're only a portion of your alternatives process. Did your macro manager produce a return that was different? Now, when you've got a whole range of alternative managers, say in the multi-asset space, who have a different bias, whether it's growth, defensive, or core, you're going to have divergent returns. And so the thing that I think is most important is not so much that there's a divergency of it, but that the manager's process met exactly what they were doing. And in some cases, some of the underperforming managers didn't. But I'd also suggest that some of the underperforming managers did precisely what their process was doing, because you need to look at an alternative portfolio in aggregate in its return.
Thank you very much, Peter. Andrew, I see you've been straining at the bit there, and I think this is a great opportunity to dive in deeper to Challenger's approach. And in particular, the thing that interests me is that this is the one approach that is wholeheartedly devoted to income. And that is something that, really a lot of advisors are screaming out for. So please give us a bit more of a detailed explanation.
So if I could go to slide 13 in the deck, I will really, really quickly recap the proposition that an annuity in 2020 and beyond represents. And effectively, upfront investment, income for as long as the client lives, irrespective of how long that lives. And I think a couple of key elements to that, linked to changes in some form of index, whether that be inflation or even recently we brought to market a product linked to changes in the RBA cash rate, for example. So certainty of income outcomes is what the proposal is here. Typically, I'm talking about payments that commence immediately, but I will factor into a bit of modelling that I'll show you. The availability of a deferred lifetime income stream, and that's come about as a consequence of client advisors looking to commit smaller amounts of capital to a certain level of income, and the current low cash rates and annuity rates that have followed that in those circumstances. And the final thing that I'll highlight is to differentiate new from old. The days of getting hit by the proverbial bus and doing your capital are largely gone. We still have that functionality available as an option, but broadly, death benefits and withdrawal values built into lifetime annuities in 2020. So that's what the product set looks like today.
Andrew, just I guess I mean annuities have been around for a long period of time. I just wonder, in an environment where interest rates have collapsed, obviously the guarantee costs something, and at least proportionally that cost is greater now than when interest rates were at much higher levels. I just wanted to, if you could comment on that, how difficult is it to actually deliver um, the required income stream or a meaningful income stream now that interest rates are so low, and what are sort of the underlying investments that you're looking at to try and support the annuity?
Yeah, absolutely. I was talking to an advisor yesterday, updating a version of a book that he's written, and he was after some updated quotes, and it was quite interesting to go in there and revisit the level of income that's coming out of a lifetime income stream. It's reduced as long-term interest rates have fallen, so have payment rates for lifetime income streams. And certainly, I would absolutely say the cost of ensuring all of a client's income is prohibitive. And that's why we absolutely see advisors factoring in different combinations of income streams. So this diversification of income sources is a really interesting combination that advisors are blending together. Effectively, you know, I'm not protecting all of a client's income. I'm protecting an amount of a client's income, and in the context of the exposure that we most commonly see, it's this: I need to protect essential expenses. I can't get by on age pension alone if everything else went to pot. But you know, an extra $100 a week on top of the age pension, I could afford to protect that. And the difference between $37,000 a year and an extra $100 a week on top of that is material in terms of a client's style of life. Backing up the assets, you know, a statutory fund with a vast array of underlying assets, predominantly fixed interest investments. That changes from time to time, and you'll see, you know, as you know, things like March flowed through the change made to the portfolio through that period of time. But effectively, that really, you know, that significant level of diversification really important in terms of security for this level of income.
Thank you. And while we've been talking, and each of you has presented, we've had a number of questions come in, which I think are quite interesting. I think some of them are specific to you individually, and some may have, interest across the board. But I'll throw some questions out there, and if you can perhaps spend a minute or two maximum just answering them. Going to you, Nigel, you talked about the cost structure. We did have a question come in, and maybe you've already answered it in your presentation, but the question is, what is the all-up cost of the Milliman model, assuming full-time protection? You would just want to talk a little bit about the cost side?
Yeah, thanks, Michael. So I mentioned at the top of the discussion that all the portfolios are less than 50 basis points. I'm not a believer that it's good to suggest it's that and then there's another bunch of costs on top of it. So when I say it's less than 50, it's less than 50 total cost. And that includes the underlying investments, it includes the model management by Milliman, and it includes the explicit risk management undertaken by Milliman. So, you know, the average is probably 45 basis points for the multi-asset fund. Bear in mind, the underlying ETFs are passive investments and can be found at a pretty attractive rates.
And you can switch on and off that overlay, if you like, protection. Does the cost change depending on whether you switch it on and off?
Yes, it does. So you actually, let me be clear, the advisors have the discretion to turn the protection off at any time at an individual client level. And we've seen advisors coming up to the US election and post the US election use that in a very tactical manner. Importantly, that doesn't disturb the underlying ETFs and create capital gains implications. So that's critical. To your question about the fees, if you were to turn the protection off, then the Milliman fee drops away, and that sits at around 30 basis point saving to the client.
Okay, thank you. Peter, questions come in the current environment, and particularly given a perspective of a retail managed account strategy. So there are obviously issues of sophistication. It has to be on APLs. It has to be researched by retail research houses. Needs to have some semblance of liquidity. What sort of alternatives would you be looking at or suggesting to investors? And obviously we've got an audience of financial advisors here at the present time.
Yeah, okay. Look, I think you want to have alternatives. You want to get as a wider spectrum of alternatives to put into a portfolio as can be possibly accepted from your client. I think the first thing in any of these discussions, it's changed a lot over this time. And I think the first question is, how much equities can your client take? Right? Having established the exposure and comfort that your client has in terms of being able to tolerate the discrepancies in the equity market will then tell you how much you want to put into alternatives. So if you've got someone who has a lower tolerance, then you have to put more into alternatives. And if you're going to put more in, I would not recommend putting more into one or two. I'd be putting them into a greater array of different alternative strategies. And when you're looking at constructing the alternative strategy, I think the best alternative tends to always be the one that you weren't in. It's just one of those awful things in the way the market operates. So that as I say, you really need to try and get as many into there. So look at, I say on our perspective, try and find some that are operating similarly to equity and put in some corporate debt. Try and find some that will operate totally discriminately to what's going on. And there are a couple of good multi-asset managers in that. Yeah, we have some macro managers there. And defensively, I think one of the hardest ones to find is a long short. I think theoretically that's a wonderful opportunity, but that's really hard to find quality managers in that space. And there I'd be just taking advice from groups like JANA, etc., to get their research and your Lomsecs, etc., and find out what they've done, because obviously they spend a lot of time looking at those guys.
And what about something like gold, for example? Obviously a relatively cheap, well understood type alternative investment, tends to have downside protective tendencies. It tends to have inflation hedging characteristics long term. What would be your thought about including something like that in a portfolio?
Personally, I've got some. Look, I think it's another example of something else to put in there, and there's several different ways of gaining exposure through gold. We don't have that exposure, but you can buy it directly yourself, or you can get one of these ETFs. I think and you can get the equity and to look at that and say, while it's in my equity portfolio, I'm taking it on for its alternative characteristic. So yes, I think a small amount of gold is suitable in there, but recognizing that it is, if you buy the metal, it is illiquid, and you've got to get. If you need the cash, then that's probably not something you go into. But you've got to have those sort of discussions with your advisor in terms of how you do that. But I think a lot of investors now are happy to take the liquidity out of their equity component. So are comfortable with having something locked away longer in some form of alternative, private equity, other things like that.
Indeed. And certainly some of the managed accounts that JANA is responsible for, there are some private equity strategies out there that are available to retail investors that have done quite well over a period of time, perhaps not as good as what is available in the institutional market by virtue of needing a little bit more liquidity. You can't have the same sort of lockup covenants in these types of strategies, but they certainly can be additive to portfolios and provide a bit of diversification. Andrew, just in regard to annuities, you showed that nice pie chart, I guess, that had the the growth portfolio, the defensive, and then you had a pie associated with annuities. I think most advisors would appreciate the ability to incorporate annuities, perhaps at a bucket approach, where the annuity is one distinct bucket representing the guaranteed income flow. Looking at it from the point of view of a more integrated portfolio construct, and particularly from a managed account point of view, have you nutted that one out? How to actually incorporate a lifetime annuity within an active managed account strategy at this point?
Yeah, so I think you're absolutely right. There are a number of ways of doing it, and I work with advisors as they see fit in terms of that approach. But I thought I'd share quickly with you one of those approaches that I think can be quite useful in that regard. And if we could go to slide 13, a very, very quick analysis for these clients. We've got a couple of clients, or slide 14 as it is, looking effectively with modest level of assets to protect a certain level of income for as long as they live, $43,000 a year in this particular case, but want to spend something like Ask for Comfortable for as long as possible. And effectively, what I'm going to show you is using a tool that we make available to advisors, the Challenger Retirement Illustrator, effectively either not using an annuity or using either an immediate annuity or a deferred lifetime annuity. And effectively, what I'm going to do with these is underpin the other assets. And I'll show you the cost of capital and the income that it produces. In each case, it'll be sufficient to meet that income requirement for those particular clients. So if we could go to the next slide, there's a lot of numbers on this next slide, but I wanted to highlight a couple of things. If I was to use an unprotected strategy for these particular clients, I retain access to all of my capital. So no compromise to liquidity. But in terms of meeting income requirements out to life expectancy of 61,900, as for comfortable, there's just a 27% chance. We use, the Willis Towers Watson engine to effectively build out these 2,000 scenarios. In just 27% of those 2,000 scenarios, I've got that level of income out to life expectancy. But if I was to put in place an immediate annuity, I can increase that effectively out to 45%, or a deferred lifetime annuity, 45%. In terms of meeting essential spending requirements, this is where the real benefit of this strategy comes in, this partial allocation underpinning the managed account strategy. Effectively, I'm guaranteeing at least essential income requirements of 43 for these particular clients. And so while there's just a 32% chance of meeting that in the circumstances where I don't have the allocation to the lifetime income stream, where I've allocated the amount into an immediate annuity, and that's cost me, 28% of that portfolio, or in the case of the deferred lifetime annuity, 14% of the portfolio. In every one of those 2,000 scenarios that I model, I'm able to provide that 43 grand for as long as that client lives, irrespective of what happens in markets over that period of time.
Andrew, thank you very much. And gentlemen, a big thank you. I think it was a very informative session. We could have gone on literally, I think, for another hour or so and gone into another layer of detail again. But hopefully this has given advisors a perspective as to the potential universe of solutions that sit outside of fixed income, particularly when they're trying to solve for that holy grail, if you like, of income, defensiveness or diversification and liquidity. Now, it may be that none of the individual solutions that we talked about today will cover all three of them, but I think each of them has a perspective on that that requirement, and perhaps in combination could go some way to actually addressing some of the shortfalls that we now find in terms of just dealing with fixed income markets. So I thank you all, gentlemen. I hand back to Amanda to close out.
Thanks, Michael, and thank you to our three presenters. And I wanted to say well done, Michael, as well, for wrangling such a complex and broad topic. As Michael says, there's probably several more hours on any one of these topics that we touched on today. So look, if you wanted to get in contact with any of these presenters, let us know in the feedback form and we'll see what we can do. And hopefully you'll be able to take that offline. Please do fill out the feedback, give us your suggestions, and we will be sending around the recordings and the presentations in, I believe it's today, shortly, and CPD certificates. Thanks very much, everyone, and have a great weekend.